in the long run, gold goes up. And you'll go through periods where, you'll go through 4 or 5 year periods, sometimes 6 years, where it doesn't go anywhere. In fact, it falls off some and people lose faith in it and it comes back and goes to new highs. But I think this time around, because of what the US has done, people want to get away from the dollar. If you're going to own anything, you've got to own gold as a hedge against the dollar, number one. But what's going to happen, because they're buying gold. They do not want, if you go look at the amount of Treasury securities they own now, it keeps going lower and lower and lower since 2013. You want to be side by side by those other countries that are buying gold, and I think that's where people probably make an error. They don't realize, well, this, and all I'm saying is you need to have enough to where, as prices move forward and you have inflation, you have things turn around, gold will stay up with that over time. It may not month to month, but it'll stay up over time.
Gold is up by 0.5%, trading in the $2,730 range during the European session on Monday, following a gain of over 1.0% on Friday. The precious metal benefits from a combination of factors, including heightened safe haven demand amid escalating tensions in the Middle East and moves by the People's Bank of China to ease credit conditions through interest rate cuts. Additionally, China's ongoing divestment from US Treasury securities is drawing attention. Since the start of 2024, China has offloaded over $21 billion in US Treasuries, with $53.3 billion sold in the first quarter alone, its most significant recorded sell-off. Data from Q3 2024, though not fully compiled, is expected to show an additional $5 to $10 billion reduction. This shift is part of a broader trend among BRICS nations to reduce reliance on U.S. debt instruments while increasing their gold reserves. TedOakley, the founder of Oxbow Advisors and a seasoned financial expert, highlights this trend, noting that countries have been shifting from U.S. Treasuries to gold since 2013. He stresses the importance of aligning with these global moves by holding gold as a strategic asset. China's accumulation of gold has been significant. Alongside other BRICS nations, China has been one of the largest buyers of gold from 2022 through 2024. In 2023 alone, China added several tons of gold, valued at $550 billion, to its reserves. This buying spree aligns with the broader narrative that BRICS countries are considering a new currency, potentially backed by gold, to challenge the dominance of the US dollar. Oakley advises that many underestimate the importance of owning enough gold as a hedge. As inflation and global economic conditions evolve, gold has historically preserved its value despite short-term volatility. With major global players like China making strategic moves into gold, the metal's long-term investment case grows more assertive. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
If you have built buildings, you're in good shape. Not so much development side, but on the gold side, if you look at gold, you just keep on going back, okay? You'll see that in the long run, gold goes up in the long run. And you'll go through periods where, you'll go through 4 or 5 year periods, sometimes 6 years, where it doesn't go anywhere. In fact, it falls off some and people lose faith in it and it comes back and goes to new highs. But I think this time around, because of what the US has done, people want to get away from the dollar. And if you're gonna own anything, you've got to own gold as a hedge against the dollar, number one. But what's going to happen, because they're buying gold. They do not want, if you go look at the amount of Treasury securities they own now, it keeps going lower and lower and lower since 2013. And so you want to be side by side by those other countries that are buying gold. And I think that's where people probably make an error. They don't realize, well, they say, and all I'm saying is you need to have enough to where, as prices move forward and you have inflation, you have things turn around, gold will stay up with that over time. The thing about the Fed is their job is to really make sure, and I know it's inflation and employment, but one of their jobs is make sure the Treasury makes it. And the Treasury's been basically doing nothing but T-bills because they know that's where they can get the financing right now, because so many hedge funds and short-term people will buy the T-bill when they won't buy a long bond. That's why we have this T-bill issuance that's going on. And the Fed itself, the problem for them is they realize that this debt load we have right now is drowning the government. So they have two choices. They can either decide to keep the rates high and make things go austere, which the economy would break, and here they would come with low rates again, which wouldn't work. or they can lower the rates lower than the inflation rate, which would happen. And then all of a sudden you're into stagflation, which is the way we think they will go. No, it may not necessarily go back to the lows, but you could see them run 3% Fed funds rate or something, and inflation be at 4.5, and that's the way I think they get out of the mix. But it takes a lot of years to do that. What I'm saying is, no matter where the rates are, they're going to be, I suspect, that they'll be lower than the rate of inflation. And so what would happen is it wouldn't make any difference if they were cheap, because yeah, you could have cheap rates, but your inflation's killing you on the other side. And I think what people don't realize is that if you look, for example, debt this year, the cost, just the interest on the debt this year is more than we're spending on defense. Well, somewhere in here, you have to say, okay, we've got to take care of these people that are using all this money in deficit spending. And so I suspect that's what's going to happen. It won't be good, by the way. I mean, if you're pushing the rates down and inflation doesn't come down with it. Now, maybe it does for a while,
Yeah.
but in the long run, I don't think it does.
TedOakley has cautioned that lowering interest rates too soon, particularly when inflation remains a concern, could send mixed signals to the public and markets. If the Federal Reserve moves to cut rates while inflation persists, it may later need to reverse course, creating confusion and undermining market confidence. This risk is especially relevant as inflationary pressures linger. Federal Reserve officials seem divided on the timing of rate cuts. On the one hand, Federal Reserve Bank of Dallas President Lori Logan suggested on Monday that more rate cuts could be on the horizon, indicating confidence that the Fed can also continue shrinking its balance sheet. This perspective aligns with expectations that economic conditions could soon warrant a rate reduction. However, Federal Reserve Governor Christopher Waller was more cautious, urging prudence on rate cuts. Speaking at Stanford University's Hoover Institution, Waller noted recent data showing a stronger than expected U.S. economy and labor market and an uptick in inflation. While Waller agreed that the Fed's policy rate should gradually be reduced over the next year, he emphasized the need for a cautious approach given that the labor market remains healthy. Inflation is still hovering near the Fed's 2% target. Let's get back to the interview.
I think one of the things you get into, by the way, as you come back to school in September and October, you get a little pickup in retail sales anyway, just from that. And I think one of the things that's happening, though, in the small business world, and I talked to quite a few of those people, is that their costs have gone up, okay? Their prices they're having to pay labor has gone up, but yet they can't push it out. They say, if I push those prices on out to the public, my business will go down. So they're sort of stuck in the middle on this thing. And then they worry a bit about, because they don't really know from the standpoint of which way the country goes and what happens in all these elections. I think that throws them a little bit. But generally, they're getting squeezed, and I think that's why they have the outlook they have. I think they've continued to borrow, David, to make ends meet and to buy what they want to buy. And we haven't gone through a period yet where people will say, I just can't do that anymore. But if you look at the number of delinquent credit card accounts that have been closed, in other words, we're not going to give you any more credit, okay? You're seeing what's happening is people are starting to, they've gone out and borrowed more to live and to do the things they want to do instead of trying to really live within their means and cut back, because it's a tough time out there right now. I think a lot of them are having to borrow just to do the normal rate of business week to week, and that's why it's going up, in my opinion. Yeah, I think so. You look at it, and I don't think they're paying for cash for sure. I mean, even if they're using a credit card, they're not paying it off.
Yeah.
The credit card rates now, believe it or not, I mean, there's a lot of them out there now. 28.9, 29.1. I've seen a number of them like that. And if you think about that, that is an egregious amount to charge to the people. I think people will do whatever they have to do so that they can, buy what they want to buy for the little ones and the big ones and everybody else in the family. They'll say, hey, we'll cut back next year. But I think going into Christmas, typically they just they say, hey, we'll do whatever it takes. David, I think they think that, hey, the Fed's going to come to the rescue here. Rates are going to go down. We're going to go back. Happy days are here again, like I said in my newsletter. And I think they're forgetting that, you're in a period now, and this doesn't make sense, by the way, for the Fed to be too aggressive on the downside when you're running huge deficits, at a time when the economy's really doing okay. And so I don't know if that was political or where they were coming from particularly, but I think one of the problems they'll run into is if you start showing 3 or 4 months of inflation here, and they've already told the world, hey, we're going to move the rates down, and then they're stuck. See, they're like, okay, no, we're not going to do that. Then you send, again, after many other times they've done this, you send the wrong message to the people out there. And so, they've gone out and bought long bonds, and then all of a sudden they may not work.
With global economic uncertainty and rising inflation, gold continues to solidify its role as a strategic asset. China's significant shift from US Treasuries to gold, alongside other BRICS nations, signals a broader move to hedge against instability. As central banks consider future interest rate cuts, the long-term value of gold becomes increasingly apparent. How do you view gold's position in the current economic environment? Do you see it as a safeguard for the future? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.